Ladies and gentlemen, if there's one thing this administration knows how to do, it's flip-flop. Tariffs on, tariffs off. Trump and Elon fighting, Trump and Elon making up. And today, in the morning, we had a China trade deal agreement, and then Besant and Lutnick shot that down. Stocks fell despite an extremely cool inflation print. So our only hope right now is Jerome Powell. And if Powell doesn't cut next week, we riot like we're in LA. Let's roll the tape. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and US stocks paused on a recent rally on Wednesday as investors digested a softer than expected inflation reading and assessed a US-China plan to salvage their trade truce. And as a result, we saw very mixed price action, but mostly red, coming off what was a fantastic start to the day, with the only sector really in the green being energy, right? ExxonMobil and Chevron leading the charge. Other than that, green was far and few between, mostly just in the big names in each sector. For industrials, that was GE and Raytheon. Netflix held it together for the comm services space. AVGO was the only green in semiconductors. IBM was green after their supercomputer announcement, and Palantir for the infrastructure side. So you could really see green was far and few between, concentrated in a couple of names: McDonald's, Starbucks, Chipotle. In tobacco, it was Philip Morrison and Altria Group. And that was really it. There wasn't really much green. A lot of the big names were very, very red. And that is why the S&P 500 was down 0.27% year to date. But all in all, it wasn't like a disastrous day. We did see upbeat momentum to kick the day off, but then we pared a lot of those gains as the day went on, with gold and energy inflation hedges for some reason outperforming despite the cool CPI data we got, and we'll talk about it a little later. Gold, which is an inflation hedge, and energy are 0.55 and 1.42% respectively. But we may also talk about why these are up there with regard to geopolitical tension a little later on in the video. Along with that, we saw utilities, healthcare, and industrials all gain, but they were virtually flat, up 0.006%, 0.004% for healthcare and industrials respectively. And then every other sector was in the red, with the worst performing sector being materials right here, down a full percentage point, followed by the discretionary space. Real estate staples taking it on the chin. All in all, it was a fairly red day, especially when you have stuff like XLK, XLC, XLY in the red. You're going to get a red day across the board. And that was true. Large caps, mid caps, small caps, value, core, and growth. Red everywhere, but again, not an absolutely disastrous day. If you look at it in aggregate, it was just another red day coming off what has been a pretty solid week so far for the S&P 500. Now, if we actually look at the overall momentum of the S&P 500, you can see here we got a massive move to the upside. And then we actually paired a lot of those gains in very volatile price action to end the day down about 0.3% or 0.27%, however you want to look at it. Now, the reason why we got this initial pop had to do with the inflation data. Now, the inflation data came in very, very cool. The core inflation rate month over month reported 0.1% against the consensus of 0.3. So a very, very cool reading. And that meant the headline year over year figure came in at 2.8% versus the 2.9% consensus. Very similar situation in the headline figures, 2.4 versus 2.5 on the back of a cooler than expected month over month of 0.1 versus 0.2%. And guys, that set the markets on fire very early on, along with news from the US-China trade agreement currently happening in London. I'm going to go ahead and read this right here. President Donald Trump announced that a trade framework with China has been completed, with Beijing supplying rare earths and magnets up front, and the US allowing Chinese students into their colleges and universities. The US and China will maintain the tariff at their current and lower levels following the agreement in London, with Trump saying Chinese President Xi Jinping must still formally sign on the agreement. The pact includes China pledging to speed up shipments of rare earth metals critical to the US auto and defense firms, while Washington agreed to ease some of its own export controls, with curbs related to advanced chips remaining in place. Now, that is all very bullish news, but then we had Scott Bessent come out and said trade negotiation with China will be a much longer process, sort of contradicting what we saw right here. We also had Lutnick come out and say, you can say that the China tariff levels won't change much from here. So pretty much, I think what he's saying is once we have the lower levels, they're pretty much going to stay at these levels in perpetuity while we continue to negotiate with China and to get everything we need. And that is why stocks sort of pulled back towards the end of the day. It was sort of this upbeat momentum at the start. And then as we paired some of these losses, we sort of had like bad trade news come to fruition. And that is why stocks sort of fell. But looking at some market movers, Tesla was up 0.43%, but was up 2% here in the pre-market on the back of Donald Trump, Elon Musk sort of reconciling their relationship, or it's looking like they're doing that. You know, Elon Musk had a very consolatory tone on X, saying he regretted some of the stuff he said about Donald Trump last weekend. For some reason, the market really liked that. Oracle absolutely ripping here in the after hours because of its earnings, up 7.38% on the day. And in fact, it was down about 3%, up 7%. So it's a 10% move. That is absolutely insane if you think about it. And that's because they beat on the top line, beat on the bottom line. Now, they only grew revenue 8% on the year. However, what I think set the stock on fire was actually their remaining performance obligations. That grew 64% year over year to $130 billion. And then Larry Ellison on the call came out and said, we are on schedule to double our data center capacity this calendar year. And that means revenue is probably going to accelerate into the double digits from the 8% mark right here. And the stock absolutely ripping. I thought these earnings were really, really good. And if you go ahead and follow me on my second channel, FinFluential Media, we're going to drop an overview of Oracle's earnings. We're going to discuss it all and talk about, is Oracle a buyer right now? Because the valuation isn't too egregious. But follow me on there. About half an hour after the upload of this video, you'll get that video. Another market mover was Archer Aviation because Donald Trump came out and signed an executive order to boost U.S. leadership in drones, flying cars, and supersonics. It's also going to make it just a little bit easier with the regulatory landscape, and a stock like Archer Aviation up 7% on that news. Very, very positive developments. And then for everything we saw today, there was 2,600 advances, 3,600 decliners. We saw net inflows in the New York Stock Exchange, outflows in the Nasdaq 100, with the S&P 500 down 0.27%. And look, guys, market momentum continues to remain fairly robust. We're above the 50% range all the way up until the 100-day moving average, and we're just below the 50% here at the 200-day and 150-day. The second we captured these, we probably are going to all-time highs. Now, guys, looking at the charts, broadly a red day across the board. Large caps, mid caps, small caps. It was all very, very red. We also saw pretty red price action in Europe right here. China bucked that trend, up 1 full percentage. And again, that's probably because of some of that trade deal news that we got from Trump and Xi. Volatility was up ever so slightly, and we actually saw yields fall on the back of that cooler than expected inflation print. The economic data came in better than expected, cooler than expected, and as a result, yields are going to fall, and rate cut expectations probably ramping up. I think right now, guys, it's going to be a very close to a 50% chance of possibly a rate cut at the FOMC. If it's not next week, it's the week after next. It's on the 18th. Let's have a quick look right here. Yes, the 18th is next Wednesday. So potentially more fuel for the markets next week. Donald Trump has been absolutely ragging on Jerome Powell. And we also saw Scott Bessent coming to the fold today. JD Vance also came out and said Jerome Powell needs to cut. So we're going to have to see what happens next week. Either way, expect volatility when it comes to that. I'm actually super excited for the FOMC because either way, we're going to get fireworks from this administration. AGG and TLT, as a result, gained because, yields fell. That's typically how it goes. And then Bitcoin was down 1.2%. Gold up 1%, silver down. Very mixed price action here in the commodities set. WTI was up 5.35% over some news that we saw in Iran and Israel. Quickly talk about the S&P 500. And guys, we're at the top end of the range. Yesterday, we saw the gamma flip lines move up, but we didn't see them move up today. We're slightly above it, as you can see right there. So that's probably telling us that we probably are going to see this as resistance. At the moment, guys, a very, very mixed day in price action. If you just go to the one-day chart, you can see we were up, we were down, we were up, and then we came down on the back of some of the news we got from Lightning and Bessent on some of those trade negotiations. And we had a lot of good news coming into the day. You can see we gapped up right here, but we just couldn't hold those gains simply because we've run up really, really far. I mean, even after this mini pullback we got right here, if you take a measured move, we're up like 4%, and you're looking at that in just a couple of weeks, right? That's like 10 trading days to see that type of move. Absolutely insane. Also, what you have to understand is that the second half of June tends tends to be fairly negative, guys. So if we actually do see a little bit of a pullback here, it wouldn't be unfounded. But ultimately, I think the best thing that the markets can do, if it really wants to inspire confidence, is go ahead and hit these all-time highs. And for the S&P 500, if we are to take a measured move from where we actually closed today to where we are right now, we're about 2.15% away. The big problem here is, let's say we get this seasonally weak June, especially in the second half of June, we get this weak June and we start to fall. That's actually going to be a lower high. So we're putting a high right here and a lower high relative. That can be a little ugly. That can get ugly. And then we could actually see the 57.55. Now, if you don't think that's crazy, again, we take a measured move from there to the gamma flip. That's a 4% move. I mean, if we move 4% to the downside in, let's say, a week, maybe 2 weeks, market participants are going to react to that 4% in 2 weeks to the downside. That's a pretty big move. However, there's a lot of support zones, and you could see the first one would be the 58.80 zone. So even if we do pull back to this level, as long as we hold it, as long as we hold this lower high right here, we probably will go ahead and retake those all-time highs. So that's what I'm looking for. Sort of what I'm looking for is sort of weakness into the back half here of June. However, if we get a rate cut next week, we will go higher. And if we get continued trade deals from Japan, we know the Japanese trade minister is coming over to the US, that's going to be fuel to the upside. If we get an EU trade deal, that's going to be fuel to the upside. So while seasonally I am a tad bearish, overall I am bullish, and I think we probably will go ahead and hit these all-time highs, if not sooner, definitely later, but I would say within the next month or so, all-time highs on the table for the S&P 500. Very similar situation for the Nasdaq 100, all-time highs definitely on that table. But if we do see a little bit of weakness here, especially to the end of the week, do not be surprised. I mean, how far is the Nasdaq 100 from all-time highs? Measured move 1%, but if we go towards the highs of today, right, how far are we? Less than 1% from all-time highs. Absolutely insane to actually see this move right here, guys. This is so crazy. In fact, the speed and breadth of this move is probably second only to what we saw in the pandemic in 2020. Like this right here, this was absolutely crazy. It doesn't look like it on the chart, but this move right here from the pandemic, that was absolutely insane. I mean, we fell peak to trough 30%, as you can see right here, and then we just absolutely ripped to the upside. Like the S&P 500 just went on an absolute tear, up 140%. I don't think that's going to happen in this specific instance, but if we do get rate cuts, it certainly is upside. And I mean, if you do zoom out on the weekly chart, right, and you sort of go out the last 5 years, this looks very, very bullish, because we got a low right here, a higher low, and then we sort of got equal to higher lows right here in the context of just continually making like all-time highs all the way at the top, and having made an all-time high, when was it? March, February, sometime around there. And if we go ahead, make another all-time high, I think the markets will continue to move to the upside, especially if earnings remains robust and the economic data continues to remain robust. But, there are some warning signs we are seeing in the economic data, particularly in the labor market, but we'll talk about it in tomorrow's video. Now, let's quickly have a look at the RTY. Now, down 0.5 percentage point, and you could see we sort of got to the top end here, and then, the bears came in a very big way, sold us off. But, the RTY has been very, very strong off these lows right here. Remember, I showed you the S&P 500 was up about 4%. I think the RTY probably double that. Yeah, up like 11% from the lows right here. So absolutely insane move that we've seen here in the Russell 2000. I do think we probably are going to go ahead, get these 52-week highs. It's going to be, if we get a rate cut next week, I think that's going to be fuel for fire, specifically for small caps and mid caps, especially these companies that are highly sensitive to the overall cost of capital. Looking at gold really, really quick, guys, you know the drill. We are sort of consolidating in this range right here, looking to form this triangle and then make our next move to the upside or the downside. Again, we're not trying to predict what's going to happen. We're just going to react to the overall market. I feel like a broken clock talking about Bitcoin, but guys, when you look at M2 money supply, offset it anywhere from 80 to 100 days, you're going to get the overall forward price action of what you expect in the market. And you can see right here for Bitcoin, we did expect a tiny bit of a pullback with M2 money supply, and then we're going to make the next move to the upside. That's exactly what we've done. And we've tracked M2 money supply very, very closely in the last year. As you can see, in these consolidation periods, in these accumulation periods, in these up thrusts, in the downward momentum, and now in the upward momentum as well. And this will continue. Looking for a target on the upper end of 140,000 for Bitcoin. Very, very solid price momentum. Very, very solid price action right here. Now, we did see Bitcoin fall 1.2% today. If you've missed this run, this is the time to get in, because, once Bitcoin goes, it absolutely just goes. It just keeps going for days and days and days on end. So don't be deterred by the price action we're seeing here in Bitcoin. We will go higher. Now, guys, diving into sentiment, this is CNN's Fear and Greed Index, and we've moved from slightly neutral into greed as the markets have, put on a rally this week so far. We've had a fairly bullish day on Monday, on Tuesday as well. And guys, if you are a bull, this is not where you want to buy. The time to buy was when we were in extreme greed about 4 weeks ago. If you are long, the thing to do right now is simply hold and sit through the volatility, especially because earnings is really, really good. When you get double-digit mid-teens growth, revenue growth of 5%, 76% of companies reporting above analyst expectations, you just want to hold in this environment because earnings are good, price momentum is really, really good. We got trade deals coming, and probably one of the most underpriced things in the market right now is rate cuts. And further solidifying the momentum is buybacks. If you look at buyback executions, the expectation is for about $1 trillion in buyback executions, 5% year-over-year growth. However, in the next couple of weeks, specifically starting next week, we should see the buyback blackout period ramp up. And that's because we are about to enter Q2 earnings season. Q1 is wrapping up in a couple of weeks. As you can see, we'll be entering the buyback blackout period, which means Q2 earnings is coming. And that could actually be the next catalyst that takes us to the upside or the downside. And if you go ahead and subscribe, we'll cover all of the latest earnings on Year and the second channel. Now, let's actually talk about the macro. This is very, very interesting. Now, we look at the Fed GDP now, tracking estimate to determine where we're standing with growth. And right now, if we look at Goldman Sachs estimate for growth, they're looking at 3.7% at the current moment for Q2 GDP, a stark difference from the negative GDP growth number we saw in March, but it is a rebound as we did see quite a lot of front running of the tariffs during this quarter right here, during growth looking really robust. We're on a rebound. There's not going to be a recession, at least according to this right here. Things looking really, really good. And the consumer continues to remain undefeated. This is a really cool chart. Father's Day spending in the US grew 7.1% on a year-over-year basis. Total spending equaling $24 billion, up from $22.4 billion in the same time last year. And average spend per person is $199, up from $190 in the same time last year. And actually, this is a high we've seen in the last 5 years. The highest was 2023, $196. We've actually gone ahead and eclipse that. So the consumer still holding in there, and we're still getting the data, and we're still getting data points from the consumer that points to quite a healthy consumer, all things considered. Looking at data in the week ahead, guys, tomorrow we only get PPI. That's going to be the biggest number. The forecast is for a 0.1% in PPI. That's the producer price index. And then earnings, we had Adobe and Restoration Hardware after the close. That's about it in terms of big names. And if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.